This lecture is over break-even analysis and operating leverage. I'm your professor, Dr. Stephen Haggard. So let's talk about two types of expenses. Hopefully you have already been playing around with managerial accounting and you've heard of fixed costs and variable costs. The fixed costs are the ones that remain the same regardless of how many units of production that we put out. And so what kinds of things might these be? Well, how about your CEO's salary? It doesn't really change. How about the rent on your warehouse? Or the electricity used to keep the lights on in your corporate headquarters? All these sorts of things are fixed costs. Then we have variable costs. These vary directly with the number of units produced. The more we produce, the higher this cost. What kinds of things do we see in variable costs? Well, there's raw material. There is labor, and there is perhaps the electricity used to produce the product. And this is why we have activity-based costing, where we try to figure out how to allocate these variable costs to the different products. For instance, our electricity bill just comes in as one bill. How much of that is fixed costs and how much of that is variable costs? Well, that's what our accountants try to figure out for us. Now, let's talk about the concept of fixed costs. I used to work for a bunch of guys from GE, and anytime you'd say the words fixed costs, they would clear their throats, and then they would say, "Do you mean long-term variable costs?" And I would say, yes, of course. And here's what they mean. Can we fire the CEO? Yes, we can. So therefore, that cost isn't really fixed. And could we sell an item that had a yearly maintenance contract with it? Yes. Well, then that maintenance contract would no longer be a fixed cost. Every cost, they say, is variable. Some are just variable in the long term, others in the short term. But for purposes of this discussion, we will just talk about fixed costs and variable costs. Now let's talk about the idea of break even. And in order to understand break even, we need to understand something called the marginal contribution. Marginal contribution is basically just the sales price, whatever I'm selling it for, minus all the variable costs that are involved in either producing it or putting it on my shelf. And so marginal contribution should always be positive. And we would hope that it's large enough that we are able to break even. What does break even mean? That means that we are bringing in enough money to cover all of our costs, both fixed and variable. And so how do we know when we've done that? Well, it'll be when the marginal contribution per item multiplied by the number of items is exactly equal to our fixed costs. And that quantity that will make this true is called the break-even quantity or break-even point. So here is a very simple break-even example. Our fixed costs are $8,000. Our variable costs are $2 per unit, and each unit sells for $4. And so we can instantly look at that and know that our marginal contribution per item is $2, 4 minus 2. So the question is, what level of production will result in zero profit? So zero profit is going to occur when the sales revenue is equal to the total cost, but that total cost is a combination of the fixed costs and the variable costs. And we know that the variable cost is going to be equal to the unit variable cost, which in our case is $2 multiplied by the quantity. And our sales revenue is going to be equal to the price times the quantity. And so we can set up the equation seen in the next to last bullet point, where 4Q is equal to 8,000, our fixed costs, plus 2Q, our total variable costs. And from there we can solve by subtracting 2Q from both sides to get 2Q equals 8,000. And then we can divide both sides by 2 and end up with Q equals 4,000. And so our break-even sales point is 4,000 units. If we sell more than 4,000, we are making a profit. If we sell less than 4,000, we are losing money. Now, something students have trouble understanding is the need to go ahead and produce and sell if we have a marginal contribution that is positive, but we are still losing money. Think about this. If we do not sell anything, those fixed costs continue on, and we have no cash flows to offset them. If we have any positive marginal contribution at all, we need to continue to produce and to sell because it will reduce our losses, and losing less money is a good thing. So let's talk about three types of break even. It turns out we can define profit, and we're going to use that term very loosely here, in three different ways. So we've got three different break-even measures. So the most widely known one that people talk about is accounting break-even. And this is the level of production that will make your net income equal to zero. But as finance majors, or people interested in finance, certainly you know that accounting net income is not cash. First of all, it's got non-cash expenses subtracted out, like depreciation and deferred taxes. And there's all sorts of gimmickry with accounts payable and accounts receivable that we have to account for. And so we have to be very careful using this. However, it's in such popular use that I will go ahead and throw it in here. Basically, we are going to use it so that you'll be able to talk with accountants about it. Now, keep in mind, though, that in finance, what we're interested in is cash flow. And the reason we're interested in cash flow is because we are interested in finding out about shareholder wealth creation. Why are we interested in that? Because the goal of financial management is to maximize shareholder wealth. Next, we have the cash break-even. That's the sales level at which the operating cash flow is equal to zero. And this one makes a little more sense from a finance perspective. It's based on cash instead of just accounting numbers, but it's not quite there to the level we would like. The best of all worlds is the financial break-even, and that is where the quantity that makes the NPV of this operation zero. Now, we are going to talk about the first two only, and here's why. We can do simple calculations on the first two using equations. For the financial break-even, where NPV is equal to zero, you basically have to do an entire capital budgeting project and then use Solver to find the quantities that would make your NPV equal to zero in your Excel spreadsheet. And so that's a little beyond our current discussion. If you want to go back and play with this concept, you can go back to a capital budgeting project that you've done previously and fiddle around with it until you can figure out how to make NPV equal to zero. So let's look at our accounting break-even variables. We have our variable definitions here. Big P is the selling price per unit. Little v is the variable cost per unit. Q, big Q, is the total number of units sold. And so our sales would just be big P times big Q. Capital V, capital C is equal to variable cost or total variable cost, which is just our unit variable costs multiplied times the quantity. FC is fixed costs, D is depreciation, and T is the tax rate. And we're already starting to see depreciation creep in here, and this lets us know right off that we are not dealing with cash. Okay, let's derive the accounting break-even formula. First of all, let's set up a simple little formula for net income. We're going to have our sales minus our costs, both variable and fixed, and our depreciation. And we're not given any information about interest, so we're going to leave that out, multiplied by 1 minus the tax rate. Now, why are we doing that? Well, that's what's left over after we pay our taxes, and that is what net income is. It's an after-tax number. Now, once we've got that simple equation set up, we can set the whole thing equal to zero. Why do we do that? Because the break-even point is the quantity that makes net income equal to 0. And so once we've done that, we can divide both sides by 1 minus t. If I take 0 multiplied or divided by anything, I get 0 back. And so basically 1 minus t just disappears. And so for the purposes of accounting break-even, taxes don't matter at all. That should also give you an idea that this isn't a perfect system. Okay, so now what we can do is add f, c, and d to both sides. Now the reason we're doing that is we're trying to get all of the things that have quantity in them on one side of the equal sign and all the things that do not on the other. And once we do that, we can substitute for S and VC because they both have quantity in them. And we know that sales is price times quantity, and VC is unit variable cost times quantity. So that's over on the left-hand side, and that's all equal to fixed cost plus depreciation. And then we're going to solve for Q. And when we do that, we basically just divide both sides by P minus V, and we get the equation in the next to the last bullet point, which is fixed costs plus depreciation divided by P minus V, which is the marginal contribution, by the way, P minus V, the price minus the unit variable cost. And so that Q, once again, is just the accounting break-even point. That's the quantity that makes net income equal to 0. Now let's move on to the cash break-even derivation. That's the quantity that makes the operating cash flow equal to 0. And the reason that we want to do this is because net income has non-cash expenses like depreciation that we must add back to get OCF. So we're going to ignore taxes when we figure OCF break-even. I do have posted in the class materials a file that has a derivation for OCF break-even with taxes. It's just a little bit different. Okay, so we're going to figure out OCF here. It's sales minus variable costs minus fixed costs. We're going to subtract depreciation and then add it right back because after all, we're ignoring taxes. Those things just go away, the D's. And so we just end up with sales minus variable costs minus fixed costs. And when we do that, we can solve for the quantity, and it's just FC, fixed cost, divided by price minus the unit variable cost, which is the marginal contribution. Now, if you'll notice, there's only one difference between this equation and the equation that we had for accounting break-even, and that is there's no depreciation on top of this one. And so for any firm that has depreciation, the accounting break-even will always be higher than the cash break-even. Let me say that again in case it might show up on an exam for you. The operating cash flow break-even will always be lower than the accounting break-even for any firm that has depreciation in their costs. Okay, and so once again, this Q that we calculate here is the break-even point. That is where OCF is equal to 0. If the quantity is higher than that, OCF will be positive. If the quantity is lower than that, OCF will be negative. Once again, we would want to undertake producing things as long as that marginal contribution was positive, simply because then we would be losing less money than if we chose not to produce at all based on our fixed costs. So let's do an example here for accounting and cash break-even. You've got a new product that requires an initial investment of $5 million, which will be depreciated straight line to 0 over 5 years. So depreciation per year will be $1 million. The price is $25,000 per unit, that's big P. The variable cost is $15,000 per unit, that's little v. And the fixed cost is $1 million per year. Now, don't get that confused with the depreciation. We have depreciation of $1 million per year, and we also have fixed costs of $1 million per year. And so we can plug these things into our equation, starting with the accounting break-even. 1 million plus 1 million is 2 million on the top. Divide by 10,000 on the bottom. Where did the 10,000 come from? 25,000 minus 15,000. That's our marginal contribution per unit. And when we do the calculation, we see that our accounting break-even is 200 units. However, if we look at cash break-even, we get rid of the depreciation on the top and we only have 1 million on top. And so then that gives us a break-even of 100 units. As a result, you'll notice it's always going to be this way as long as the firm has depreciation, that the cash break-even is lower than the accounting break-even. Let's talk about operating leverage. Operating leverage is the relationship between changes in sales and changes in operating cash flow. Now, you may see this stated in different ways in other places. You may see it as change in EBIT, or earnings before interest and taxes, divided by the change in sales. Or you may see it as change in net income divided by change in sales. But the concept is very similar regardless of what we put in the numerator. So the degree of operating leverage measures the relationship between these two things, the sales and the operating cash flow. The higher the degree of operating leverage, the greater the variability in the operating cash flow. So how do we determine what the degree of operating leverage is? Well, the higher your fixed costs are, the higher your degree of operating leverage. And we can look at the formula at the bottom here. Degree of operating leverage is equal to 1 plus the fixed cost divided by the operating cash flow. And we can see that the degree of operating leverage depends on the sales levels that you start at. So for instance, with higher sales levels, you're going to have higher operating cash flow, but you'll have the same fixed cost. And so as our sales levels rise, our degree of operating leverage reduces. But as our sales levels fall, so do our operating cash flows, and so the degree of operating leverage will get larger. Now, how do we apply this thing? Well, let's say if we have fixed costs of 200 and operating cash flow of 100, that fraction is going to be 2. 2 plus 1 is 3. And so that means for every 10% change in sales, we would see a 30% increase, in profits for a 10% increase in sales. Now that sounds pretty good, and you're thinking, wow, I've got to get me some of this degree of operating leverage because the higher the better. Except for one thing. What happens when sales drop by 10%? Well, then we see our operating cash flow dropping by 30%, and suddenly it's not nearly as much fun to have a high degree of operating leverage. So let's talk about the previous example. Suppose the sales are 300 units. And so that's going to meet both of our break-even measures. Operating cash flow break-even was at 100 units. Accounting cash flow break-even was at 200 units. So what's the degree of operating leverage at this sales level? Well, it's easy enough to figure out. Our operating cash flow is that marginal contribution times 300 minus our 1 million in variable or fixed costs. That's 2 million. And our degree of operating leverage is therefore basically 1.5, because we're going to take our fixed costs of 1 million and divide by our operating cash flow of 2 million, and that gives us 1.5. So what's going to happen then if to our OCF if our unit sales increase by 20%? Well, our degree of operating leverage is 1.5. It means that our operating cash flow will be up by 30%. And so our operating cash flow would go from 2 million up to 2.6 million. Now let's talk in some concrete examples of why degree of operating leverage is as it is. Think about two car factories. One that runs primarily on robots, one that runs primarily on people. And so I'm going to use two factories in Ohio as my example. One is a General Motors plant, which is primarily driven with robots because of their high labor costs. And the other are the Honda plants that are in the opposite part of the state, where they don't have unions and their labor costs are lower. Those plants run primarily on people. If you want to increase capacity in the Honda plant, you have to go out and hire another shift of people. And so to go from 2 shifts to 3 shifts, we might have to hire 5,000 people. If we go from 2 shifts to 3 shifts at the GM plant, we might only have to hire a dozen people to watch the robots. That means when sales are good, GM's costs are only going to go up a little bit for those extra 12 people, and they'll get 50% extra production. But Honda's expenses are going to go up quite a bit more because they're having to hire 5,000 people additionally. And so the profits are going to go up greater at GM than they're going to go up at Honda. That's because of this degree of operating leverage. It's higher at General Motors because fixed costs are a bigger portion of their costs. But let's think about the downside. What happens when you're running 2 shifts and then suddenly sales only require 1 shift of production? Well, at Honda, you can lay off 5,000 people. That cuts your costs pretty dramatically, so your profits don't drop nearly as far as they do at GM, where you can only lay off 12 people and your profits plummet.